Well, good afternoon, everyone, and a special good afternoon to our ECA members joining us today. First of all, welcome to everyone to our webinar, Minimising Risk in an Unstable World. So as you all know, from Brexit to Trump, political risk continues to be a growing concern in the global market. How resilient is the economy to the series of shocks? Which industries will be most impacted by these uncertainties? Where does this leave Australian exporters? And more importantly, how can you protect your exporting business and remain profitable while trading in this uncertainty? Well, today we have three experts here to answer those questions and most importantly, your own. So throughout the webinar today, please make sure that you're taking down any burning questions you have and writing them to us in your comment box below. We'll be taking them all, and at the very end, we'll be able to go through with our experts and answer all of those questions. So make sure you take them down. So as I mentioned today, we have three fantastic speakers from Coface Australia. They're going to be able to talk to us extensively about risk management and, importantly, how to get paid. So today we have Rob Golding, the head of sales from Coface. We have Johnston, the VP of risk underwriting. And we've also got Kim Hall, from the head of claims and collections from Coface. So today with the webinar, each of our fantastic speakers are going to be giving us a short dynamic presentation about how to minimize risk in an unstable world. And at the end, we're going to be going through your questions and putting them to our panel. So to start off today, we have Rob Golding. Rob Golding is the head of sales at Coface Australia, specialising in trade credit insurance and how it can be used for business expansion. Rob has extensive experience in Australia and globally. He has been helping businesses for more than 25 years to increase sales and expanding into new markets with confidence, protecting their most valuable assets, their trade receivables. Our second speaker is Johnston, VP of Risk Underwriting for Coface. Having spent a number of years working at Export Finance Insurance Corporation, APAC, in political risk and industry-specific risk assessment, and now Vice President for Risk Underwriting for the Asia-Pacific region for Coface, John has expertise in understanding macro trends and building meaningful insights. John has helped a number of businesses manage their risk exposure while investing funds into the right areas to maximize growth opportunities with greater certainty. And finally, but certainly not least, we have Kim Hall, the head of claims and collections for Coface. In claims and collections, Kim has extensive experience in navigating businesses through complex circumstances when non-payments, disputed debts, or insolvencies occur. Kim has enabled a number of businesses to recoup losses by way of insurance claims or successfully collecting debts. Managing debt overseas for exporters is often challenging, but with a network covering over 200 countries in debt collection, Coface has a solution for you. So our first speaker today is Robert Golding, so I will hand over the floor to Rob.
Christina, thank you. Firstly, I'd like to say welcome to all and thank you for joining this webinar. Coface, as long-standing partners of ECA, are delighted to be here today with you all, and we'd like to take this opportunity to, as our presentation suggests, support you in growing your business successfully and minimising the downside of dealing with customers overseas, i.e. your export sales. And with that in mind, I'd just like to refer you to our overview slide where we'll take you through, together with my co-presenters, where we'll go through the different sections. I will firstly start off with buyer failure, which will cover both domestic and export customers. Then my colleague John Johnston, who is our head of risk, will talk about the implications of country risk, because that is another area of risk that you don't have per se with any domestic customers that you may have, but it's very critical to be aware of once you start going abroad, especially in different regions of the world. And then following that, in the event that, and this is what it all comes down to, minimising risk, i.e. getting payments. The worst thing that we know concerns all our SMEs, and just quickly, we insure 500 billion of trade receivables globally around the world. A good portion of that is SME exports, okay? So we have over 70 years of experience in working closely with our export customers, SMEs and globals as well, in doing cross-border business successfully and navigating the challenges as and when they arise in different parts of the world. And following on from that, as I said, when we're in the event, and sadly it does happen, when a customer gets into trouble or a country risk impacts, which Johnston will outline, then there will be the need to collect the payments. And that will be done by Kim Hall, our claims and collections expert, supported by our network, our COFAS collections services all around the world. So with that in mind, and again, thank you again for attending, I'd like to firstly start on buyer failure, which I would hope a number of these key points will resonate with you all. And as per the slide, and we're just taking just quickly Europe, for example, and this is what we track very closely. We track the insolvencies levels on an annual basis. And please let me say, the GFC wasn't all that far away, and it could be argued that the world hasn't improved in all parts of the world as much as we'd like. The insolvency rates per country, per region, is a very good guide on the ability of customers to pay. And we track that through, as I said, per country, per region, and we break it down through industry sector. So moving on to the next slide, manager buyer failure risk. As you'll see, three key points. Please let me say again, with our global experience of SMEs all around the world, those 3 points relate to customers where they may be in the world. And what we see is that one of the main reasons for a buyer failure is, I don't like to say the word poor management, but what it really is, because a lot of these customers vary from, your customers could be SMEs, they could be larger corporations, etc., etc. Please let me say, we see a lot of these points in all different sizes of customers. It just doesn't relate to the 1 million, 2 million, 3 million turnovers. Sadly, in some industries, we pay very large claims on customers with 100 million turnover. So, and a lot of it can be summed up in these 3 points. So, talking about poor strategic management, it's really about, is the customer more sales focused? Is it growing their business at all costs to the detriment of proper and good credit control? As we all know, a sale isn't a sale until you get paid for it. And normally, when a problem comes, the ability to recover, any recoveries that may be there becomes even more difficult. So it's important to keep on top of that. But again, it's really getting to know your customers, how well they manage their business. Where are they in their own marketplace? Are they number 1, number 2, number 3? If you can, try and get a breakdown of their own customer base. Are they reliant just on 1 or 2 big customers? And if so, if one of those customers, not even default, but stops buying from them, what is the impact on your customer's business if their largest customer walks away? Does that create cash flow problems? Do they produce product for this customer that they can't on-sell elsewhere? And if that's the case, that's a lot of money lost. So it's really doing as much drill down as you can on your own customers. And it becomes even more challenging once that customer's abroad, because as we know, getting information from different parts of the world, like in Australia, you've got mercantile reports, DMV, etc., Vita, and you also got asset, where public companies have to release their financials. But between companies that have to release their financials and a lot of other companies, private companies, unless you can get financial insight, then it makes it even more challenging to review the customer to get a feel of their financial standings. And that leads directly onto the second point, inadequate cash flow. Getting back to my point, some customers, and we see it, they're all about growth. They're all about grow the top line, grow the top line. They get to the point where they overstretch themselves. And what happens then? Their main financier, the bank, that will, 9 times out of 10, will have a charge over the assets of that customer, will go in there and say, look, you're overextended, you can't survive, we're going to pull the pin, put in an administrator. Okay? When that happens, you as a supplier will become an unsecured creditor and you'll have minimal rights. The bank as a secured creditor will step in there with their administrative receiver and make all recoveries, and they'll pay themselves out. So sadly, a lot of suppliers in good faith, trying to do business, trying to do their own business, is caught out due to the acts of your customer's major funder. And we do pay a lot of claims in that example that I've just outlined. So, and then moving on to the last point, which I've kind of covered as well, trading losses. Okay, your own customer, as I said, if one of the largest customers fails or stops trading with them, and this is what you do. And one of the real world ways to track this is your payment experience from your customers. Okay, track this. Look for any slowdown in payments. Look for any increases in disputes, especially ones that are not genuine disputes. And I'm sure you've all experienced genuine disputes, but disputes are a very good indication that they're struggling to pay. Keep constant contact with them. Don't harass, obviously, but stay close with them and talk about their businesses, especially if they're an important customer to you. Speak with them, understand where they're going over the next 6-12 months, where they see their market growing, what they see they'll need from you in terms of your own products and services. So with that in mind, so a lot of this comes from experience, of course. You've got a lot of help to do that. People like ourselves with the products that we offer. Also, you have the ECA that will help you a lot in actually meeting the requirements with your own exports into different markets. And you have the likes of Austrade and APAC as well. So overall, all I can say is constant due diligence, track your customers, see how they're faring in their own markets. And one last thing on this, a solvent buyer today does not necessarily mean they'll be solvent in 3 or 6 months' time. So good, prudent consistency, but overall, there is a lot of growth. A lot of our business comes from exporters successfully selling all over the world, so it works. And I hope on that basis, that gives you a feel of how to closely monitor your buyers. And with that, I'll now pass on to my colleague, John Johnston.
Hi, good afternoon, everyone. My name is John Johnston, as Rob just said. I'm going to talk about country risk issues, but first I'm going to put that into some context, and particularly in context of the global financial crisis, which has in many ways redefined how we look at country risk and the sort of issues that we think about, and also there has been a continuous uncertainty in different parts of the world as a consequence of the financial crisis and the issues that created that crisis in the first place. So when I think about risk, there are a number of points that I would automatically consider, and those points are the supplier. What do I know about the supplier and their product? What is the product? What's the demand like for the product within its sector or within different parts of the world? And what impacts on the demand and price of that product. some products and commodities in particular have a global price matrix and may be influenced by a fall in demand in a particular country, and that's something that we've seen over the past few years, where there was overcapacity in the steel sector in China, for example, which reduced the demand for iron ore and squashed prices for iron ore and created a lot of chaos in the mining and resource sector. We also think about the payment terms, how secure are the payment terms, and certainly since the global financial crisis in particular, we've seen a fairly concerted move to unsecure terms like open account, as competition for business has increased. We also think about the buyer, what we know about the ownership, the activity, the experience, the track record, and the financial profile, if that sort of information is available. And then, in addition to that, we think about the country in which the buyer is located and what sort of risks we need to consider in order to underwrite a request for insurance cover. So, in general, the risks that we would think about are the legal system in a particular country, the ability to enforce a contract, and the ability to pursue a debt if there's a default, for example. The quality of the information, which is generally the transparency that is available on individual businesses and the business sector. The quality of the information may be that in many countries businesses are tax effective, so if you get financial statements, you already know that they're not going to reflect the true performance of a business. And within the region that we're located, which is Asia Pacific, there are many countries where financial statements are tax effective, and that includes China, Thailand, Indonesia, Vietnam, Philippines, for example. And even in Australia, transparency is very difficult because it's difficult to access financial information, as it's not publicly available and it's treated as confidential. We also think about issues that might relate to import restriction, issues that might relate to foreign exchange controls, for example. So from that backdrop, one of the challenges that we have been facing over the past couple of years has been the dramatic volatility in oil price. And in particular, that's had prolonged impact on countries that have a dependence on production and export of oil, for example. So if we look at, say, the Middle East, for example, there are a number of countries in the Middle East where oil represents a high level of the GDP and also a high level of the export revenue that particular countries earn. So Algeria, for example, the dependence on oil is about 40 to 45% of GDP, and the dependence on oil as a export revenue earner is about 98%. So there's a huge dependence on oil. And if you think about what's happened to the oil price since 2014, where we saw trade at $120, $130 a barrel, dropped to a low of $30 a barrel in 2016, and more recently it's around $50 a barrel. So that's a huge drop in revenue, and there's been some volatility upwards and downwards since that deterioration started in 2014. But if you think about the volume of oil that is produced by some of these countries and the high dependence that these countries have on the price of oil, you can imagine the impact that it's going to have on the economic health of particular countries. And again, if we look back to the Middle East, we can see that countries like Angola, 45% GDP, 95% dependence on oil for export revenue. Bahrain, 11% GDP and 60% dependence on revenue. Even Saudi Arabia, which is 55% dependence on GDP and 95% dependence on export revenue, has suffered some consequence of the decline in oil price. And here we're talking about a country that has more than $500 billion in foreign exchange reserves. But the problems that we're seeing as a consequence of the drop in oil price is reduced government spending, which has an impact on infrastructure, which has an impact on the construction sector in these particular countries. We're seeing a reduction in government investment, government spend on social services, government spend on subsidies, for example, subsidies that may relate to energy. We're seeing import restrictions in some countries, and Algeria is a recent example where that is happening. And we're also seeing some level of foreign exchange restrictions as well. And this is primarily as a consequence of the volatility and the decline in the price of oil. And as a consequence of that dynamic on risk, we are seeing payment problems in a number of industries. The construction industry in Dubai, for example, we're seeing problems relating to the import of dairy product. We're seeing problems in the chemical sector and the distribution sector as well. And that's all a consequence of, I suppose, the lack of cash that is circulating in the marketplace, banks becoming more conservative in their lending practices, and just a negative perception of economic health and a lack of clarity as to when the circumstance may improve. So I think that's just kind of comments in a nutshell, really, about the impact of a particular commodity, the impact of a particular commodity price, where it has high relevance to economic health and the impact that it can have on risk, and that impact can be quite far-reaching. The impact is not just specific to the product itself. It can have a much more broader impact if it means that government spending becomes more cautious, if it leads to a lack of consumer and business confidence, if it leads to wage freezes or wage cuts, and if it leads to import restrictions and foreign exchange controls. So I'll just hand you over to Kim, which is perhaps the next part of the equation, where we talk about risk, and now we talk about how to recover funds if there is a payment issue.
Yes, thank you. My name is Kim Hall, the head of claims and collections here at COFACE. Thank you for this opportunity. So we've heard from the experts, Rob and John, in regards to risk minimization. But what happens when that all starts to go wrong? So you've done your due diligence, you feel like you're protected, you've ordered the credit report that says the chance of failure on this particular buyer is less than 3%, and alas, you find yourself facing your invoices not being paid when they become due and payable. I'm going to just speak now to a case study that we have whereby we have a policyholder who exports to Indonesia. Meat trader here in Australia has a buyer in Indonesia. They have done all their due diligence, the health certificates, the contract signed, price is agreed, everything's good to go. The buyer picks up the goods from the dock and then decides that they feel that they've been overcharged and they want to then negotiate price once they've received all goods. What happens then? You've got a buyer over in Indonesia and you're sitting in Australia. So you lean into the experts on the ground. Here at COFACE we have, as they've said, experts in 200 countries around the globe, and Indonesia is one of them. So the debt is handed over to our experts over in Indonesia who are local. They know their market, they know the appetite, and they also know what's important, most important in this situation, which is their legal system. And they begin to put the pressure on the buyer to get repayment. They had a signed contract, agreed to price. There's a contract repudiation in place at the moment. What happens? They know their legal system. They provide recommendations to us here in Australia, so you only have a one-point contact, and they're able to collect the money on your behalf while you take care of what's most important, and that's growing your business. There's another case study that I'd like to talk to you about at the other part of the world, which is in the Middle East, where milk's distributed from a buyer here in Australia. It gets everything's done, due diligence, contract signed, price is agreed to, the product gets there and they refuse to pick it up from the dock. They decide then that it's just not something that they need or want anymore. What happens then? You go into, you load the debt through to COFACE Australia, and we get the experts on the ground over in Dubai to begin that risk minimization on your behalf, as opposed to you having to take the time out of your busy schedule to collect on those types of debt. What the crux of it is, when you pass on your debts to the experts and the specialists, it allows you to focus on what you do well, and that's growing your business. It takes the pressure off of you from having to collect the debt and puts the pressure or the responsibility on a third party, so you can continue to maintain your relationship with your customers and allow the experts on the ground in the countries that you export into to do that risk minimization for you. One of the things that I would recommend in doing that is when you start noticing, I mean, it's obvious when a customer is refusing to pick up goods, but when you start noticing payment pattern changes with customers that have not refused to pick up the goods, but you start noticing that there's been a change in their payment patterns, get onto it as quickly as possible and refer that matter over. So you can get the quicker the debt is referred, the more likely it is to be statistically proven, the more likely it is to be collected quickly, and that gets cash back into your bank account.
So hopefully that's now given everyone an overview of the steps the opportunities and the challenges that you have as you continue to grow your business, not only just in your existing export markets, but you may be looking to expand into other markets in that region. I earlier referenced ASEAN, sorry. ASEAN is 11 countries, 600 million people. Quite a vast difference between the individual countries. Like Singapore, as we all know, is first world. Then we have Thailand. Then we have Indonesia. And we have parts of Malaysia that you would call third world, so to speak. So the real knowledge of knowing not only your buyer, but as John has outlined, knowing the market that you're selling into. What are the potential implications that may affect your customer in their own home buyer? So this is all there, and it comes through experience, and a lot of people do this. So while we're saying how to minimise your risk, please don't think there's not opportunities. There's great opportunities, but what makes us very sad when we see some of our insureds, smaller insureds, if you don't mind me saying, potentially new into the business, new into exporting, or as I say, going to another markets, where unfortunately they get caught out because of some dynamics, some areas where maybe they've not realised or not experienced before. So we hope with this overview, it gives you a feel, and we'll happily take this offline with each of you individually to further expand if you've got certain markets or customers you'd like to discuss with us. And I'd just like to finally touch on something that is very key to us and very key to the market for SME exporters going forward. And you'll see the last diagram, financing. Over the last 12 months, we've been working very closely with financial institutions, banks, okay? And historically, please let me say, our industry, credit insurance and banks, have worked closely together for many, many years. And we look how we can even work even closer in how we can provide a package to our customers, our clients, and the bank's clients, mutual clients, SMEs, medium-sized, large, and how we can better finance them, because we see that not only there's the risk of the buyer default, but there's also the ability to finance those sales, those orders that you receive overseas. And the bank has their own exposures, and we work with the banks to try and help minimise their exposure and, in a nutshell, be able to provide more and hopefully more competitive trade finance, i.e. cost to you. So this is an area that we're together with one or two banks, which are also long-standing partners of ECA, where we're continuing to design, hopefully, a program that you may be of interest going forward. Because one thing that's come out to us very evidently, and from speaking with our your colleagues at the ECA, is that we see some SMEs fund off their credit cards, if you don't mind me saying, and that's a killer. That's massive. We also know that banks, especially for the smaller SMEs, are very hesitant to get involved. And please, let me say, and I know that everyone has a view of big banks, but they have what we call a counterparty exposure. And that really comes, there's two areas. It's not only the exposure on your customer, where we help them. Please don't take this the wrong way. The counterparty exposure is on yourselves to do your own business and to manage your own business, etc. And they have their own constraints within the bank. That is the area, that is the two areas we're trying to work with these two particular banks to support them in the counterparty risk, or offlay that counterparty risk, so they can work even more closely with yourselves to provide what we would hope would be a more attractive financing solution than what is out there in the market. So again, it's still, this has been ongoing for 12 months now, where we're getting to the stage where we will be sitting down with, and I'll be careful how I say this next point, we are in discussions with a government entity on this, but we're hopeful that in the next 3 to 6 months we'll be able to bring something to the market, and we really do see better, more attractive financing for exporters is key to growing the sales and supporting you doing the business that you want to do. So I now throw it over to Christine for Q&A.
Fantastic. Thank you very much, Rob, and thank you to all of our speakers. So we do have a couple of questions. And once again, if you have any burning questions, please write them in the comment box below and send them through to us, and we'll read them out for the panel. So one of the first questions, so you both touched, so I think all of the panelists touched on knowing more about your buyer. What types of questions do you need to be asking during contract negotiations to make sure that you have the right information? So I'll throw that out to all the panelists. Please jump in.
It's John Johnston. I suppose when you're discussing a potential sale, you really need to think about what it is that's going to make you comfortable putting your goods or your money on the line, particularly if they're being shipped to an overseas country. So you need to think about the logistics, the payment terms, and how that's going to be financed. When you come down to considering the buyer, I suppose you need to sort of recognize how you became aware of that buyer in the first place, whether it was through a recommendation from a business that you know, whether it was through Austrade, whether it was through a direct approach from the buyer. You know, what context was that sort of initial contact made? Because that may give an indication of the sincerity of the approach in the first place. But I suppose one of the big challenges that we've seen since the global financial crisis is an escalation of fraud, and that's been particularly prevalent in doing business in China, and also in the commodity trade relating to Indian distributors and traders. So I would start the process. I mean, I suppose it depends on what resources you have, but you certainly need to get some background on the ownership of the business and the experience of those individuals, how long they've been in the industry, how long they've actually been involved in that particular business. If you get a sense that they have a lot of experience and that the business has been established for a number of years, then it's possible you can get some trade references. You could ask the buyer to give you some contact details so you can approach other suppliers and get their opinions in terms of doing business with the buyer. You can ask the buyer what they actually do, what is their activity, what is their customer base. If it's a family-owned business, maybe you can get some insight of the commitment from the family to the business. If it's a business that's owned by a number of different shareholders, and there may be other activity that they're involved in, so you can get a bigger picture of the total business activity of the individuals, whether they own one or more different businesses, so you get some perspective of size and longevity and commitment. I would suggest that if you're one of the first things that you should be considering is to try and get a mercantile credit report on a business that would give you the basic publicly available information on a business. That would tell you when the business was established, who the directors are, who the shareholders are, usually what the paid capital is, would give some insight of the activity of the business, and in some countries you'd also get some insight as to whether there is any legal action or court cases taken against the business. Now in some respects it depends on what country the buyer is located in, because you may be able to ask for a profile of the business, you may be able to get some financial insight, you may be able to get the names of the bankers and then in turn get a bank reference. But if we're talking about culturally sensitive countries, and you know, that's many of the countries in Asia, I suppose that's where it might be a good idea to consider something like credit insurance, you know, to have a third party involved that can make a decision for you about how valid the buyer may be, or how viable the buyer might be, and from a risk perspective, from a payment perspective.
That flows on.
And you can also. I was also going to say that, you know, it's possible you could also, if you're talking about a contract, if you're talking about payment terms, it's probably a good idea to start on secure terms to begin a relationship, if that's possible, so you can build a track record so that you can see that the buyer has some ability to pay. And you may also be able to ask for some level of, or some type of security to give a level of comfort, like a upfront payment, or perhaps a standby letter of credit or something like that.
Fantastic. Well, that actually flows on quite nicely to another question, which is around debt collection. So which countries are particularly difficult to collect from, and are there any that you shouldn't even bother with?
That is a very loaded question. So there are several countries that are quite difficult to collect in, but more importantly, it's the legal system that is quite slow there. So from India to even Italy, where it can take up to 3 years to get a judgment, as opposed to less than 30 days here in Australia. So that's the comparison for you. So it can be quite, if the customer or debtor, and by the time they get to the collection stage, if they are aware of these, the slowness of their own legal system, then it can cause them to drag their feet, knowing that there's not going to be any real ramifications negatively against them for up to 3 years. That's why you have to get really good, tenacious collectors are in there to minimize the losses. So from India, like I said, to Italy, and then over in the Middle East, it can be quite difficult as well, because the legal system is very slow, and they have different ways of going about things. So I can't even quote to you how long it takes to get judgment, because it takes a while. You have to go through a mediation process that needs to be mutually agreed upon by the collecting agency as well as the debtor. And then they'll have to put forward a mediation request if there's not going to be a mutual agreement to be able to meet with that buyer and get any kind of positive resolve. As far as places that I would not recommend trading with, that's really hard for me to gauge, because there's issues in every country. You're going to run into issues in every country. So that's a really hard question for me to answer as to whether or not you should definitely not export into a certain country. Maybe JJ can help with that one.
Thank you very much.
Thank you.
Maybe I can just add that if you're thinking about exporting, there are some websites that could be quite useful. I think that there's a World Bank website that gives statistics in terms of how long it may take to enforce a contract and the different steps that are involved. There's another website which is, I think it's called Transparency International, where it gives statistics about the levels of corruption in different countries, which is, I suppose, is a reflection of the quality of the legal system and also the business environment. Because one of the principal issues, especially where you're dealing in developing countries, is how legitimate is the legal system, and what confidence could you have that you're able to get a judgment as a foreign company against a local business. And in terms of countries where it may be difficult to conduct business, I'd probably put Myanmar forward as an example, because it's still very much a frontier economy, and the business environment is still developing. The legal system is very immature, and it's difficult to know what success there would be in terms of debt collection or enforcing a contract. And we haven't had that experience since the fall of the military regime, but it's definitely a market where I would suggest that anyone that is contemplating trade, you need to be very cautious and to be very sure that you're dealing with the right business partners there, and that you've got an effective process in place to make sure that payment is made.
Yeah, so on that question, I'm definitely getting a sense, and this is something that the ECA would always tell people, is do your homework. So even if you know the company, even if you've met them in person, understand the environment that they're operating from and what their assumptions or limitations might be. So I know that Coface has extensive resources on the ground and in terms of your market research and planning and just genuinely making sure that you're aware of any emerging trends in global trade. So I am sure you have got some fantastic resources. Where can exporters go to learn more about potential markets that they want to trade with, and what those sorts of opportunities, challenges they might be facing? And are they free?
Christina, thank you. Yeah, yes. Answer to the last question first is yes, it is free. We would encourage all ECA members to access our website, www.cofas.com. On there's two particular areas that we would suggest they look at, is news and publications. That covers a mirror of areas that we talked about in this webinar today. Payment surveys, market, trade sectors, industries, regional performance, etc. And the other part, which is very good, is economic studies. And this comes back to the second question that you asked. What markets should we trade in? What ones are best to be avoided? These economic studies are real world. They're real world. They provide our clients, or anyone, as I said, that accesses our website, with an up-to-date feel for that market, what the overall picture is, where we see, and we have hundreds of credit analysts and credit risk underwriters around the world in country. So all this information is collated and uploaded into these reports. And just, again, they're free and they're up to date.
Fantastic. So I would say to everyone, that is roughly concluding our webinar. We will be posting this online shortly, so this information won't go anywhere. You can reach out to Coface, obviously using the contact details you can see on your screen, You can obviously reach out to the ECA as well. If you're more of a social media animal, we do have some links here for you to continue the discussion on social media, or even to pose questions. So at Aussie Export for the ECA, and at coface_in_AU for Coface directly. That concludes today's webinar. We'll be sending around all the information. Thank you so much for attending, and a big thank you to Coface for taking the time to walk us through your level of expertise and also to answer some of our questions. So once again, thank you to everyone, and please reach out to us offline if you have any further questions.
Thank you, Christina. Thank you, members.